While the equity markets may be facing volatility, what is strong is India's bond markets. Let's discuss the outlook for the months to come. I have with me Abhishek Bisen, the head of fixed income with Kotak Mahindra Asset Management Company Limited. Hi Abhishek, wishing you a very happy Diwali. Let's start off with what's lending the Indian bond market that relative strength, because today we're looking at yields being particularly attractive for India.
Thank you, Mubina, for taking this question. Actually, if you look at, we have been highlighting about the India fundamental story for some time now. And if you observe, this fundamental story is actually unfolding gradually. Now, what fundamental story I'm talking about? This is especially to do with the fiscal profile, which we have done exceedingly well. Another thing is, if you look at the India and GDP growth in terms of world, we are going to be in top three economies in, let's say, over next 5 years. This can be a slightly longish tenor, but the direction is very clear. So if you join the dots, we believe that there is a possibility, a clear possibility of a rating upgrade. Now, this rating upgrade is going to take you in a different league altogether. So once you are there in that league, other window opens. If you've played snakes and ladder in the childhood, probably something like that. This is just like a ladder will just take you different league altogether. Now, what is that? That is including in either the Bloomberg larger indices or a FTSE larger ones. So this is a $1 trillion club. The moment you get into that, multiple billions of dollar flows come into India. So this thing is getting brewed very, very slowly, which is not evident at this point in time. But yes, the direction is very much in line with what story which is getting built currently.
Now, it's also the US yields and the US dollar that are pretty strong. What's your take on their impact on India's rupee and Indian yields?
Again, a good one. So this one-on-one correlation we spoke about earlier as well has sort of broken as far as the fixed income is concerned. And earlier, what used to happen was when US used to move, let's say, upwards in 10 basis point or so, India used to move 12, 15, or 20, depending on what kind of scenario it was. But if you observe off late, the spreads have compressed significantly, which is inherently reflecting what we discussed in the previous question. Now, what is happening into the US markets? Uh, there are a couple of events which are brewing uh, ahead of what is happening in the geopolitical space. So, geopolitical space is whatever was happening for some time now. There is an election in the US, which is one of the big event, and it is going to change the political landscape. And in such kind of event, when it is especially towards the end of the year, the risk aversion gets reflected in the US treasuries across the world. So this is what is getting paired for the time being, because people are, they don't want to bet on anything at this point in time, and it is slightly getting exaggerated as at the same time, because we are in a decelerating kind of mode, but still there's a sharp move upwards. So if you put in numbers, from 370 we've gone almost 435, which is good 65 basis point spike in the bond yields, while 370 was exaggerated on the other way. 435 also probably is, maybe we can say it is a comfortable zone. Market is kind of balanced as far as the treasuries are concerned. So it should not lead to any kind of major spikes irrespective of the outcome. Overall, the trend will build once the government is there, policies get formed out. So it is going to build over a period of time. There is no threat as such to India. If you look at in terms of currency, the dollar appreciated significantly over last 1 month, about 4%, while the INR depreciated just about 0.5% or so, despite in rupee terms almost a lakh crore worth of outflow and probably more. So if you look at that magnitude, actually we would have depreciated a lot. But given the fundamental strength, active RBI, FX reserves, all put together, we have done a exceedingly good job.
What's the outlook on Indian yields from here on?
So, Indian yields are, if we just talk about a broad trend, we are on a decelerating cycle. We've seen a peak of rates. A near-term data was, in terms of inflation, if we look at, was slightly negative, if we can say, but that was a known fact. It was not a surprise. And inflation, a one-off or maybe a couple of data points is not going to deter anything. All it can do maybe give you an opportunity to enter the markets. But if we look at a broader trend, it has not changed the picture at all in terms of inflation. Now we have on the month end, we have a growth data as well. So that is going to be a critical part. However, since GDP doesn't, it's not as volatile as the inflation number. Overall picture seems to be we are in a decelerating rate cycle, and if not in December, but coming in February, a rate cut probability will increase significantly. However, if the data surprises you on the lower side, let's say closer to 6.5 on the GDP, which is a low probability, but if that happens, then the probability for December cut increases significantly. By the time we are in the policy, we will have lot clarity on the developed market in terms of US elections, and war scenario, which intensified so far, probably will be much more clearer. But one thing which market has missed out or not giving any significant importance is the oil. Oil is trading at closer to $70 mark, which is a very good combination for us. US Treasuries being, let's say, closer to 4.5, and oil at $65 is a much better combination than US Treasury at 370 and oil at 90. So, overall, it is very important aspect for the Indian economy to perform well, and the rates to lead lower.
All right, Abhishek, thank you so much for that. That's the word coming in on the Indian debt market. Thank you so much for watching. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.